In March of 2023, Silicon Valley Bank collapsed in less than 48 hours. $16 billion in deposits, gone. Customers woke up to frozen accounts. ATMs stopped working. The government had to step in to prevent a total meltdown. But here's what they didn't tell you. Silicon Valley Bank wasn't an isolated incident. It was a warning sign. Crack in a dam that's about to break. Right now, your savings account, your checking account, the money you've worked years to build, sitting in a system that's far more fragile than anyone wants to admit. And in the next 15 minutes, I'm going to show you exactly why the next banking crisis isn't just coming. It's already here. We're just waiting for the dominoes to fall. Let me ask you something. Do you know how much of your bank deposit is actually at your bank? Most people think their money is sitting in a vault somewhere. That when you deposit $10,000, that $10,000 is there, waiting for you whenever you need it. That's not how it works. Banks operate on something called fractional reserve banking. When you deposit money, the bank is legally required to keep only a fraction of it on hand. The rest, they lend it out, invest it, gamble with it in financial markets. Before 2020, banks had to keep at least 10% of deposits in reserve. But in March 2020, the Federal Reserve reduced that requirement to zero. Your bank is now legally allowed to have none of your money actually available. Think about that for a second. Now, you might be thinking, but wait, aren't deposits insured? Isn't there FDIC protection? Yes, the FDIC insures deposits up to $250,000. Sounds good, right? Here's the problem. The FDIC has about $128 billion in its insurance fund. Americans have over $18 trillion in bank deposits. It means the FDIC can cover less than 1% of total deposits. If even a handful of major banks fail simultaneously, the FDIC wouldn't have enough money to cover everyone, not even close. And this isn't theoretical. We've seen this movie before. In 2008, Washington Mutual failed. It was the largest bank failure in U.S. history at the time, with $307 billion in assets. The FDIC had to step in. But Washington Mutual was just one bank. What happens when it's not just one? What happens when the contagion spreads? Let's talk about what's happening right now, beneath the surface, that most people aren't paying attention to. First, commercial real estate is collapsing. Office buildings are sitting empty because of remote work. Shopping malls are dead. And banks are holding hundreds of billions in commercial real estate loans that are going bad. Regional banks are especially exposed. Pacific Western Bank, First Republic, Western Alliance. These aren't small community banks. These are multi-billion-dollar institutions. They're all sitting on massive unrealized losses. Second, interest rates. When the Fed raised interest rates at the fastest pace in 40 years, it destroyed the value of bonds that banks were holding. Banks bought treasury bonds when rates were near zero. Now those bonds are worth 20, 30, sometimes 40% less. Silicon Valley Bank failed because they had to sell bonds at a massive loss to cover withdrawals. They weren't alone. Nearly every bank in America is sitting on unrealized losses right now, as they just haven't been forced to sell yet. Third, the everything bubble. Real estate prices, stock market valuations, corporate debt, everything is overinflated. And when bubbles pop, banks are always the first casualties. You know what's interesting? If you go back and read news from 2006, right before the 2008 crisis, everyone said the same thing. The fundamentals are strong. There's no reason to panic. Banks are well capitalized. Sound familiar? Now here's where this gets really important, and I want you to stay with me because this is the part that affects you directly. When a bank fails, there are two ways the government can handle it. The first is a bailout, where taxpayers foot the bill to save the bank. We saw that in 2008. The government gave banks hundreds of billions of dollars. But there's a second option that most people don't know about. It's called a bail-in. In a bail-in, the bank doesn't get rescued by taxpayers. Instead, the bank takes money directly from depositors. Your savings account becomes equity in a failing institution. Ouch. Your money doesn't disappear, technically. It just becomes shares in a worthless bank. This isn't conspiracy theory. Bail-ins are official policy. They were used in Cyprus in 2013. Depositors woke up to find their accounts had been raided to save the banks. And the legal framework for bail-ins exists in the United States, Europe, and most developed countries. If you think that sounds insane, I agree, but it's already on the books. Now, if you're watching this and thinking I need to send this to someone I know, do it. Share this video. It's because what I'm about to tell you next is how to actually protect yourself. And the people you care about need to hear this too. Also, if this information is valuable to you, hit that like button. It helps more people find this video. Subscribe, because I'm going to keep bringing you the information that mainstream media won't touch. So why now? Why is this crisis coming now instead of 2 years ago or 2 years from now? Because multiple catastrophic factors are converging at the same time. Factor 1. Government debt. The U.S. government is over $36 trillion in debt. Interest payments on that debt are now over $1 trillion per year. That's more than the entire defense budget. The government is spending more on interest than on veterans, education, and infrastructure combined. And here's the kicker. They can't raise interest rates to fight inflation without making the debt crisis worse. And they can't lower interest rates without letting inflation run wild. They're trapped. Factor 2. The dollar's dominance is eroding. For decades, the U.S. dollar has been the world's reserve currency. That gave the U.S. an enormous advantage, the ability to print money and export inflation to the rest of the world. But that's changing. China and Russia are trading in yuan. Saudi Arabia is accepting yuan for oil. BRICS nations are creating alternative payment systems. The dollar's monopoly is ending, and when that happens, all the inflation we've exported is coming home. Factor 3. The derivatives time bomb. The banks hold over $200 trillion in derivatives contracts. That's not a typo. $200 trillion. For context, that's more than twice the GDP of the entire planet. These derivatives are supposed to spread risk, but they actually concentrate it. When one institution fails, it triggers a cascade. Lehman Brothers in 2008 had $600 billion in assets. When they went down, they nearly took the entire global financial system with them. Today's banks are bigger, more interconnected, and more leveraged than they were in 2008. In Factor 4, public confidence. The banking system runs on trust. When people believe their money is safe, the system works.
Right.
But the moment people lose confidence, it's over. Bank runs spread faster than wildfires, especially in the digital age. In 2023, Silicon Valley Bank went from solvent to insolvent in 48 hours because depositors could move money with a phone app. There were no lines at the bank, no visible panic, just billions of dollars disappearing electronically. The next bank run won't be people lining up on the street. It'll be millions of people clicking transfer on their phones at the same time. Let's talk about what a real banking crisis looks like, because this isn't just about numbers on a screen. When banks start failing, the first thing that happens is capital controls. The government limits how much cash you can withdraw. They did this in Greece. They did it in Cyprus. They'll do it here. ATMs will have daily limits. Wire transfers will be restricted. Moving money out of the country will become difficult or impossible. Next comes inflation. When the government has to choose between letting the banks fail or printing money to save them, they'll always choose to print. That's what happened in 2008, that's what happened during COVID, and that's what they'll do next time. Your savings won't disappear overnight, but they'll be worth less every single day. 20 years of saving could lose half its purchasing power in a couple of years. Then there's the real economy. When credit freezes, businesses can't make payroll. Supply chains break down. Unemployment spikes. We saw this in 2008, when unemployment hit 10%, and the next crisis could be worse. And here's what really keeps me up at night. When people lose faith in the banking system, they lose faith in the currency itself. That's when you get hyperinflation. That's when societies collapse. Argentina, Venezuela, Zimbabwe, Weimar, Germany. It's happened before. It can happen again. Now, I'm not saying the United States is going to become Zimbabwe, but I am saying the warning signs are there. And if you're not preparing, you're gambling with your financial future. Before we get to solutions, drop a comment and let me know. Are you worried about your savings? Have you started preparing? I read every comment, and I want to know what you're thinking. All right. Enough doom and gloom. Let's talk about what you can actually do. First, diversify where you keep your money. Don't keep everything in one bank. If you have more than $250,000, spread it across multiple institutions. That way you're covered by FDIC insurance at each one. But honestly, don't rely on FDIC insurance. Spread your wealth across different types of assets. Second, hold physical cash. Not all your money, obviously, but enough to cover expenses for a month or two. If the banking system seizes up, you need to be able to buy food, gas, and essentials. Cash isn't an investment, it's insurance. Third, hard assets, real estate, if you can afford it. Precious metals like gold and silver, these assets have held value through every financial crisis in human history. When currencies collapse, gold doesn't. You don't need to become a doomsday prepper. Even having 5 to 10% of your wealth in physical gold or silver is a hedge. Fourth, get out of debt. If the banking system crashes, your debts aren't going away. In fact, they might get worse. Variable interest rates could spike. Credit lines could get frozen. If you're carrying high-interest debt, pay it down now while you can. Fifth, build skills and relationships. In a real crisis, your network is your net worth. The people you know, the skills you have, the community you're part of, those things matter more than any number in a bank account. Learn how to grow food. Learn how to fix things. Build relationships with your neighbors. These aren't financial strategies. They're survival strategies. And finally, stay informed. This crisis isn't going to announce itself on the evening news. By the time mainstream media tells you to panic, it's too late. That's why I make these videos. It's to give you the information before everyone else figures it out. So subscribe if you haven't already. Turn on notifications. Because the best way to protect yourself is to see what's coming before it arrives. The coming bank crisis isn't a matter of if. It's a matter of when. You can't control the Federal Reserve. You can't control government policy. You can't stop the crisis from happening. But you can control how prepared you are. You can control whether you're standing on solid ground when the earthquake hits. The choice is yours. You can ignore the warning signs and hope for the best. Or you can take action now while you still have time. Or you can take action now while you still have time. I know which one I'm choosing. Thanks for watching. I'll see you in the next one.